Ready to go?
Yeah, I'm rolling right now.
Okay. 3, 2.
Good afternoon. This is Tay Chayathivong here. We are talking finances today, and we have a very special guest who's been around for some time in the industry. Please welcome Gerry Hogenhout. Did I say your name right?
Okay.
Take 2.
Cut!
I was gonna ask, you know what, I
Hogenhout?
was gonna actually mention that before we start. Hogenhout.
Hogenhout.
Yeah.
Okay.
Hogenhout. I was gonna
Good
mention
thing
it
you weren't
before.
introducing me.
Oh my God, Smith. Tay Smith, here she is.
Okay, Hogenhout.
Hogenhout.
Hogenhout, right? Hogenhout.
Hogenhout.
Hogenhout. You got it.
Hogenhout. Okay?
That was
Okay.
it.
Okay, we're rolling.
I knew you were gonna stumble on that.
Take 2. 3.
Hi, and welcome to our show. Today, your cut.
Take 3.
Okay.
3, 2.
Hello, and welcome to our show about finances. Today, we have a very special host, Gerry Hogan. I'm the host. Cut. Cut.
Yeah.
Sorry.
Take 4.
Okay, hold on.
That's good. I love it.
Okay, hold on. I'm the host. This is our
This
guest.
will be great bloopers.
Okay.
That's fun.
2.
Hello and welcome to our show on finances. My name is Tay Chayathivong. I am your host, and today our special guest is Gerry Hogenhout. Cut.
Cut.
Hogan. I got it.
Hogenhout.
Hout.
Hogenhout.
Like out with a H.
Hout.
Hogenhout.
Say it 3 times.
Hogenhout.
Gerry
One more.
Hogenhout. Gerry
Gerry
Hogenhout.
Hogenhout.
Gerry Hogenhout.
Again.
Gerry
Jogan.
Hogenhout.
Jerry.
Gerry Hogenhout.
There you go. You got it. That's it.
Gerry Hogenhout.
Okay.
Okay.
Good. Take 5. 3, 2.
That's good.
Hello and welcome to our show on finances. I am your host Tay Chayathivong, and we have a special guest, Gerry Hogenhout. Welcome to our show.
Thank you very much. It's great to be here. I appreciate you inviting me. I welcome any chance I can get to talk taxes or investments. So thank you very much.
Thank
Appreciate
you. Well, we just finished part of the RSP season, but before we get into some heavy topics, please tell us more about yourself and the company you represent.
it. Okay, well, I'm a chartered professional accountant, so my background is tax, public accounting. I started with Deloitte Touche Chartered Accountants, worked in their small business and tax department. I was kind of climbing their corporate ladder, and the entrepreneurial bug hit me, so I realized I didn't really belong in that corporate structure, and left there, set up my own tax practice, and got involved in the investment world after that. So that's
Okay.
a little background.
Well, I'm very impressed that you have your CPA and you also have your CFP.
CFP, yeah, that's correct.
Do you want to talk a little bit more about how you got into going this route?
Yeah, well, when I worked with Deloitte, I left Deloitte and set up my own tax practice, and then I became very interested in the investment world. In fact, I added financial services to my tax practice back in 1995. Best investment decision I've ever made. It's a wonderful marriage of the two industries. So I needed to get my CFP in order to be accredited for that industry. And then again, the combination of investments and tax really led me to what I'm doing today, which is I've created a company, Canadian Investment Services. So it's an investment platform used by different companies, different people. So we certainly use it to deal with the general public. We use that platform within some other companies that we have. So that's what we've done recently. Yeah.
Okay, and how long has this company started?
Just recently, just since I deal with a lot of accountants in public practice, so there was changes in that industry that allowed us to work with accountants in public practice to provide investment services, and that happened in August 2016. So that's basically when I started that company.
Okay, excellent. So are most of your clients accountants?
Well, I have investment clients, so those are my own clients. So I have my own investment business. I deal with a lot of high net worth clients. So that's one side of my business. The other side of my business is to deal with accountants in public practice and provide investment services to their clients. So
Okay.
the accountant is my client, and then I provide investment services to the accountant's clients. So
That's excellent. That's a
Yep.
great partnership that
Yep,
you've
it is.
created. And I definitely see a need for that. You mentioned a lot about investments. Do you want to talk more about the types of investments that you do deal with?
yeah, absolutely. So I've dealt with different investments over my investment career, and the way I kind of describe it to people is, it's interesting. Canada is one of the only Western civilized countries that does not have a federal regulatory system. We regulate by province. So in Ontario, we are regulated by Ontario Securities Commissions and the Financial Service Commission of Ontario. So those are our regulating bodies. Underneath that, we have what I call 5 investment marketplaces. So one is stocks and bonds, the other one is mutual funds, private equity, mortgages, and insurance. So I've been in licensed, governed, and worked in all of those industries. So what I've done is create a company that basically offers all those investment products within those industries. So that's kind of what sets us apart, I think, from other companies. So we like to have access to all of these investment products. So that's how we base our company.
Okay. Are there any preferences for the type of investments that you do for yourself?
Well, again, it's more I try to figure out what the client likes. I've always thought this financial industry has kind of got it backwards. They start with a product and then they do financial planning with that product. Where I like to start with financial planning, and then we figure out what the client likes, what the client wants, and we use those products to pursue our financial planning goals. If you ask me what I like the best, I like private equity. I think we get the best value, we get the best opportunities in the private equity field. So again, when I mentioned that there are 5 marketplaces, stocks and bonds, mutual funds, private equity, insurance, and mortgage, I like the private equity marketplace the best.
Yes, with private equity, I understand there's a lot of regulations. It's very seldom you hear people talk about it. It's not advertised on television so much. You don't hear it. Is there any reason why you think that there's such a restriction?
You're absolutely right. Very few people know about the private equity marketplace, unfortunately. And the reason is because, again, as I mentioned, in Canada we regulate by province. So in Ontario there was always restrictions to enter that marketplace. And when we compare that to BC and Alberta, they had very liberal rules for private equity. So we saw a lot of private equity investments, a lot of success stories, a lot of happy investors in BC and Alberta, and the industry has been lobbying to the government for years and years and years to expand that private equity marketplace. There was a time just recently that it was only what we call accredited investors, which is defined as somebody having $1 million of investable assets. So that eliminated a lot of people. Since then, the industry has created this new category called eligible investor, which means anybody now who has $400,000 of assets, including their house, if they earn $75,000 a year, or if they earn $125,000 as a spouse, as a couple, they're now eligible to put $100,000 into private equity as an eligible investor. So the door has opened up. People are starting to find out about it, and that's good news. There's, again, the private equity industry needs funding, so this is a vehicle for them to achieve funding, and the door has opened. So it is a growing marketplace.
Excellent. What about the different vehicles that people use? So we hear about TFSAs and RSPs. So just to lead on with the private equity, can you put private equities in your RSPs or TFSA?
Yes, you can. Basically, you can put any product that you have in an RSP, you can hold that outside of an RSP, and vice versa. Anything you hold outside of an RSP, you can hold inside of an RSP. There's some qualification. That's more of a general comment, but there's a lot of misunderstanding there because people think only certain products can be put into an RSP. But
Right.
really, I know there are some restrictions, differences, but in essence, everything you hold in a registered account, an RSP, can be held in what we call a non-registered account, which is outside of the RSP. Yeah, absolutely.
I've heard about having mortgages held in an RSP. Can you talk more about that? Because that's very new to
Yeah,
me.
thank you for asking because that's something we actually specialize in. We do a lot of that, and that once again is something that's very misunderstood and not known about. And I don't know if I'm allowed to say this, but I can explain to you why people don't know about it. Think of it this way. If you're at the bank, and I don't mean to pick on the banks, but I will just for a second. If you have a $100,000 mortgage at the bank, and if you have $100,000 in an RSP at the bank in their mutual funds, they're making 2.5 spreads on each of those on your mortgage and on your investments in your RSP. In my opinion, it'd be much better to hold your own mortgage. You get rid of all those fees, you're paying yourself. So to me, that makes a whole lot of sense. We don't hear the bank recommend that at all. They don't want to lose those fees on each of those products. So that's why a lot of people don't hear about this stuff. I'm an advocate for that type of structure. So there's a lot of benefit to holding your own mortgages, not only your own mortgages, but third-party mortgages in your RSP. People need to realize that they can lend what we call arm's length, so to an unrelated party. Inside your RSP, you can lend a mortgage to somebody, and that's a good investment. You're secured against the property. You're getting anywhere from 8 to 15%, depending on the type of mortgage, so that's a pretty good return.
Are there higher risk involved?
Depends how you define risk. I define risk as not knowing what you're doing. So if you know what you're doing, I think you eliminate a lot of the risk. There's a risk in everything. Every single investment decision that we make or investment options that we have, there's a reason to invest in that, and there's a reason not to. So I think it's important to make sure the client knows the reasons to invest in a particular investment and the reasons not to. So when you ask me, are mortgages risky? It depends. If we're lending to a good qualified property that the loan to value is in good, it's not a high loan to value. It's a house that, let's say, is in the medium market. So I don't like lending against $2 million homes. I don't really like lending against $1 million homes. But when you go to a town, and I always like the 1 to 2 or 3 hours outside of Toronto. So if you go from Barrie to Kitchener to London, between Mississauga and those three, if you lend in that area, and if you go to a subdivision and see a $500,000 house, and that person might have a $300,000 first mortgage at the bank, and they need another $100,000. So our loan to value is 80%. That's okay. Lending that type of house person $100,000, I think we've eliminated a lot of risks. We also put a lot of clauses in the mortgage document that, hey, if you bounce a check, it's not a $75 fee. It's a much higher fee. If you're behind in your property taxes, there's a fee. If you don't pay on maturity, there's a fee. So we put a lot of clauses in there to protect the lender. So in my opinion, that mitigates a lot of the risk. There always can be a default of payment. So we put clauses in to make sure the lender is protected, and ultimately, if somebody walked away from their house, the lender gets the house. So we just want to make sure there's enough loan to value that protects the lender. So yes, there's risks, but we mitigate them.
Okay, what kind of questions do you think investors, whether they're new or they're used to a certain type of investment, what kind of questions do you think investors need to ask or have an idea what it is that to figure out for themselves so that it's suitable for them? And
Yep. Okay, you've hit on a key word, suitable. In our industry, we want to make sure the investments are suitable. So obviously investors have a lot of questions. I think it's important for the investor to understand two things, the investment industry and the investment product. So investors can ask all kinds of questions, but I kind of direct them to, okay, first let's give you a better understanding of the investment marketplace. Let's answer a lot of the questions you'll have about individual products. And then we can figure out what products work for you. The client needs to know the reasons to invest in a product and the reasons not to invest in a product. So all the questions that they ask fall into those categories, and I try to direct them to make sure that they have a good understanding of the industry, a good understanding of the product, and the reasons why you should invest and why you shouldn't invest. And I try to let them make the decision as far as which products work for them. So that's kind of how the approach we take.
Okay, that's good. It's always important to make sure your clients know what they're doing and that it's in their best interests. How do you navigate clients who have kind of an unrealistic expectation, or they're not up to the news of what's happening with interest rate? Like, how do you keep them?
Yeah, well, again, they have to be realistic. In our practice, I try to hit what's called the sweet spot. So my sweet spot is 8 to 12% while mitigating risk, okay? I'm not the guy you come to try to make 20, 30, 40%, okay? If that's what the client wants, then, to me, their expectations are a little unrealistic, and I might tell them that. If they want to make 40%, I always use the stock market. I'm not a big stock market fan, but when a client says, should I buy this stock? I want to make 30, 40%. Okay, well, we can gamble. The stock market to me is your gambling money. So that's where we can try to get higher rates of returns, take greater risks. But in our practice, we try to get that 8 to 12% annual return, and we can do that with mitigating a risk, getting rid of a lot of the risk. Real estate is a wonderful industry where we can get those returns and really mitigate a lot of that risk. So the client has to be realistic. And it's also, dependent on how much money they have. I mean, we try to do the financial planning to see that they have enough money throughout their lifetime. And so that has to be realistic, that the rates of return that we need to accomplish our financial goals are actually achievable. So it's a lot of work with clients to make sure their expectations are realistic and within their means.
Okay, you talk a lot about real estate. Seems it's something that you're really into. Do you want to talk more about what it is about real estate that is so exciting for you?
Well, exciting. Well, yes, I find real estate exciting, but I find it, it goes back down to the basics. Everybody likes real estate. That's where we started. And then we get into all these other different products, and we kind of go back to the bricks and mortar investing, I call it. Real estate is easy to understand. That's what I find. There's a lot of investment products out there that, people have a hard time grasping. Real estate is easy to understand. There's a house. We put a tenant in there. The tenant is going to pay us rent. There's 3 reasons that we invest in real estate. One, we hope there's capital appreciation. Every month when we have a tenant paying our mortgage, our principal goes down on our mortgage. So that happens every month. So that's the second thing that happens. So the first one is appreciation. Second one is mortgage principal pay down. And the third one, hopefully there's a net cash flow from that rental property. That's easy to understand. That's easy to explain to a client. And also, the other reason too, I just find real estate, again, when I talk about trying to get our sweet spot between 8 and 12%, real estate is the easiest asset to use that, to accomplish that. Anytime anybody invests money, it's secured by something. If you're in the stock market, it's secured by a piece of paper. If you invest in real estate, it's secured by the bricks and mortar. So again, I think we have much better security for the asset that we're trying to achieve those 8 to 12% rates of return. The other reason why I like real estate a lot is because everybody needs to live somewhere. So if we concentrate on a specific real estate market, because let's back up a bit. When we talk about real estate, that's a big, expansive market. We could be talking commercial real estate, residential real estate, U.S. real estate, Canadian real estate. So in that real estate industry, we drill down to what we like. And what I like is residential, multi-unit. I like when those type of products gear towards the $1,000 to $2,000 monthly rent. Okay, they're not high-end units. They're units, affordable units. The vacancy rates are very low. If we stick within the marketplace I like, which is 1 to 2 hours outside of Toronto and southern Ontario, there's a lot of opportunity to invest money in those type of assets, those type of real estate assets, to get that 8 to 12% rate of return. Those rental properties that, let's say, have the $1,000 to $2,000 monthly rent, they're not on the high end. They're probably more the medium to low. The low end of the real estate market is based on a cap rate. So when people go, oh, but there's going to be a market crash, you know, there always can be a correction. I don't know about a crash. You know, how low can a $400,000 house 1 or 2 hours outside of Montreal go, or Toronto? So I think that's a very secure marketplace. So that's, we really target on all that. So I like that. That's why I like real estate, because it just accomplishes what we're trying to accomplish for clients.
Well, I think it's important that people have a good grasp of their investments and look further down the road of what their life is going to be like as you come close to retirement. You know, you don't want to be at a point where, oh, I should have done this, I should have done that. What do you think are things that you're hearing a lot from your, I guess, more elder clients? If they could teach the younger generation, we've got lots of millennials.
Yes.
What do you think would be some of the advice or the hindsight knowledge going back to tell our younger generation?
Yeah, good question. One quick answer: pay yourself first. Okay, the millennials especially. Take 10% of your pay, put it aside, invest it monthly. Make that your nest egg. If you do that at a millennial age, you will be fine. But people don't do that. So that's one message to you know, millennial, anybody. Take 10% of your paycheck and invest it, and keep it invested, and don't touch it, and let it grow. So certainly that's one thing. You have to be realistic in your spending. I mean, especially, you know, again, you mentioned you know, millennials. They want everything. They want the 60-inch TV screen. They want the brand new car. You know, where we live in a materialistic world. Is that within reason, within the income that you earn? So that's something we have to teach millennials. You have to live within your budget. Budgeting is very important. You know, figure out what you make. It's not rocket science. Figure out what you can spend. Make sure there's something there. Make sure you pay yourself. So I think budgeting is, you know, and paying yourself first are probably the two most important things that I could, you know, try to explain to millennials how they can succeed. And it's the same for elderly people. They're budgeting too. So, you know, we all have a limited time on this earth, and we need to make sure we have money to, you know, to buy the things we need. So budgeting is important. Spending within your means.
I'm hearing a lot about people also living longer, so the retirement age is being pushed forward or pushed back, however you want to see it, and then people are living longer and living with certain ailments. What do you think about this idea that people are living a lot longer, and the whole generation now is, you know, before, I know, like with my family, you know, we're expected to take care of our elders as they get into that stage in life, but now it's kind of not there, just like marriage is kind of not at the forefront of people's life plans.
Yeah.
So what do you think about that?
Yeah, well, it's a big concern. I mean, good and bad. Great that we're living longer. From a financial planning point of view, we better make sure we have enough money. And it goes back to budgeting, making sure that we live within our means. So, you know, again, when we talk about millennials and budgeting, it's also with the seniors. So, you know, we have this really neat financial planning software package that basically illustrates a person's financial life from where they are today to age 100. And, you know, it'll show what their assets and their money are depending on how much they're earning. So that's an important document, because you're right, people live longer. And they can run out of money, and that's sad, because when they do, the family is expected to step in, and that creates a whole other byproduct of potential problems. You know, some of the family might have money, some not. Some can contribute toward the cause of their parents, some cannot. You know, and we see the effects of that. We see a lot of seniors living in subpar conditions that they, you know, probably, would probably rather have a higher life standard of living. So again, budgeting, living within your means. So that's important. So, I mean, again, it's a good problem that we live longer, but, you know, we have to make sure the resources are there. I mean, the system gives us so much, but, you know, when I see seniors just simply relying on Canada Pension and old age security, that's a concern. So, and again, the earlier people can start and realize, again, if they're starting to invest early, then they can deal with these issues later on in their lives because they have you know, some capital.
Yeah, it breaks my heart to see people living in conditions that you know that they could have made better choices, you know. But one of the things I've learned in my journey is until I got into the finance industry, I had no idea anything about financial planning. I didn't know to seek help. I didn't know all these things existed. So, how can people make up for that? Like, when do people go seek a planner sooner? How can you get them to really get up off their butt and
Yeah.
and think about it and actually do something?
Well, step one is lobby our government to get financial education into our school system because there's the biggest problem. Okay, I have volunteered my time to school boards to go and speak to students about finance, and they won't even let me in the room. So you know, the financial education has to start in school. It also has to start at home. So because it's not being provided in the schools, a lot of that responsibility needs to fall on the parents as their kids are raised. Once they're out of the nest, the kids are on their own, and these young kids saving for when they're 60 and 70 is not that important to them. What's more important is the 60-inch TV screen and you know, all the other material things that go along with being a young person. So again, it's education, it's budgeting. You know, the system really has to start educating these kids about financing. So that's very important. So thank you for asking.
Okay. We spoke a bit about the types of investing and starting sooner. So we know there's the RSPs, and so the season just passed, and the TFSA. Is there any advice or anything, any food for thought that you would like people to consider before they put it into an RSP or a TFSA?
Yeah, you keep mentioning RSP, and I'll be honest, I don't like RSPs.
Okay, it's
I'm
not a first time
financial
I've heard
planner,
that.
and I'm not a fan of RSPs. And I'll explain why. People ask. I'm not opposed to them, but the way I describe it is, in the tax world, we have different tax brackets. Okay, so keeping it very simple, think of 4 building blocks. The first building block is 0 income to 50,000 income, and that's 20% tax rate. 50 to 100, the second block is 30%. The third block, 50 to 150 of income, is 40%. 150 above is 50%. So we have 4 blocks and we have 4 tax brackets. If we can put money into an RSP and get a tax deduction at the high tax bracket at 50%, that makes sense. And if we can then pull that money out of an RSP, because when we put it in, we get a tax deduction. When we pull it out, we pay tax. If we can put it in and save 50%, and we can pull it out and pay tax at 20%, then I don't mind RSPs. If we put it in at 20% savings and pull it out at 50% tax, that doesn't work. And I see a lot of people doing that. So there's many other reasons why I'm not a real fan of RSPs. But your topic about saving, you don't need an RSP to save money. The same investments that you hold inside of an RSP, you can hold outside of an RSP. So I like to have people start an investment plan as young as they can, but outside of the RSP. Keep it outside of the RSP. Okay, we put money in RSP for 2 reasons: to save for the future and to save tax. There's other ways to save tax, and we use the same products to save for the future. So again, you know, it's a kind of a bigger topic as far as why I don't really like RSPs, but I'm just touching on it. And again, I'm not saying they're bad, but make sure you get a good tax deduction going out and you pay less tax going out. taking the money out. Remember also, when somebody passes away, their RSP, if it doesn't go to the surviving spouse, is fully taxable. So in my day as an accountant, I have done far too many tax returns where I had, final tax returns, death tax returns, where I have to say to the surviving children, here's the final tax return of your parent, and they owe 50% tax on the RSP. That's sad. And that's giving a lot of money away. So again, many reasons why I don't like RSPs, but that doesn't mean we can't use other vehicles to accomplish what we're trying to do, which is save for the future.
Right. So we talk about a bit about estate planning here. So that's definitely an issue. Do you want to talk a little bit more about some other issues that go on with estate planning? Because I think people are also leaving certain things a little bit too late, and you
Yeah.
don't want to die without a will
Right.
or an outdated will.
Yeah, yeah. So the best advice I can give to people first is to talk amongst the family. Okay, I've just had too many clients in my day that say they'll find out what they get when we pass away. We're not going to talk to our kids about our estate planning, and I'm like, that is so wrong. Okay, so my first message would be to openly discuss your estate. As a parent, you openly discuss your estate planning with your family. And that avoids a lot of problems. It clears things up. Everybody knows what's happening, okay? You also need to have your estate in order, okay? So you need to have a will, because if you don't have a will, the province will step in and they'll take a large chunk of your money as fees to administer your estate if you don't have a will. So dying without a will is not a good idea. Have a will, have a power of attorney. Okay, now in Ontario we have powers of attorney for finance and for health. So, and they come into play when somebody is incapacitated. So if somebody becomes incapacitated, make sure there's somebody there that you trust that can look after your financial affairs and your health concerns. So those are important estate planning basics, and it still surprises me how many people do not have those things in place. So certainly, if I can give any advice, it's talk to your family, make sure your family knows your plans, have your powers of attorney in place, have your will updated, and from there, talk to estate specialists so we can minimize tax. I mean, one thing we want to do is minimize tax that goes to the next generation. So that's important. So many aspects of that, yes.
Excellent. And you talked a bit about some of the taxes. So I've learned, one of the best ways to minimize taxes is having insurance, because you're not paying really dollar for dollar depending on when you get it. But a lot of people are not reviewing their insurance needs as quite often as they could be, or they're thinking, oh, I'll get it later, or I don't need this. What would you say to people about their ideas about insurance, if they're not looking at it, if they're looking at it in a way where it's actually going to hurt them and their families later?
Yeah, well, insurance is an important part of any financial plan. In my opinion, insurance is definitely needed as you have young kids. So if something ever happened, then they have money. Once the kids are out of the nest on their own 2 feet, in my opinion, there's less need for insurance. I'm not saying you shouldn't have it, but it's not as important as when these kids are 100% financially dependent on the parent. But insurance also comes into play later on in life. We deal a lot with people with companies, corporations, holding companies. Okay, so in theory, a corporation can earn money. That money goes up to the holding company, and that holding company starts investing their money. What happens when that holding company has a lot of assets in it? Okay, again, on death, that holding company is deemed to have been sold. So we got a big tax problem. Insurance is a great way to solve that tax problem. So we can create an insurance policy that covers the tax component on the ultimate death of somebody that would have a holding company that has a lot of money in it. And also that insurance policy can actually be used to create tax-free income. So it's a very good vehicle both when you're a parent with young kids, and it's also a good vehicle as you get older and you're increasing wealth within your holding company. So lots of different tools in insurance can play in somebody's estate planning and lifelong planning. So it's a very good tool.
Excellent. So I want to talk a little bit more about insurance. So we know there's life insurance.
Yep.
We didn't really touch base on critical illness
Yep.
or disability
Yep.
or long-term care or just personal health benefits.
Yep.
You know, as a financial planner, you're looking at lots of life stages.
Yep.
What do you think people starting a family, what are some things that are critical for them to understand and to see the bigger picture in the event that somebody gets diagnosed with something, or you know, you hear about the stats for men are becoming disabled before the age of 65.
Yeah, sad. Again, insurance, certainly helps in those cases. So, as financial planners, we have to look at all different types of insurance. Critical illness is important. I mean, we, we find out we have a disease. Wouldn't it be nice if we got a nice check to help us through that? And that's what critical illness does. It provides that disability. We could easily become disabled. So hopefully we have a nice insurance policy that will guide us. So as financial planners, we always kind of look at worst case scenarios. What could happen to you? Let's make sure we're covered. So that's very important. And again, insurance plays a big part in that. Now, unfortunately, if money is tight, insurance is one of the first things that people cancel. So you got to make sure that that people understand what if they are adding insurance or deleting insurance, what the implications of that are to them if something happens. So very important to include that the insurance in your overall plan.
What about insuring children or leaving insurance for grandchildren? I know that's a big topic when I go to certain places.
If you get an insurance policy on a young child, that's a very cheap insurance policy for that child later on in life. So it does make sense. Again, it depends on how much money is available to accomplish what we're trying to accomplish. But,
Right.
if money is less of an issue, it's a great idea to put an insurance policy on a young child, and it'll be a nice, it'll be a fantastic insurance policy at a very inexpensive price when that child is older. And it's a great idea.
Yes, I definitely like it. And I didn't know before, I thought insurance, you just got it at a company when I was very young. But then I learned you can get your own, and there's term, so it's temporary, and then
Yeah.
there's permanent, and there's ones that actually is an investment tool, or you can use it as collateral. So knowing that, what is the, I guess in an ideal situation, what would somebody have for
Well, you want to
coverage?
make sure that there are insurance proceeds. One, to look after those that depend on you for finance, and two, to deal with the taxes that will ultimately happen on our demise. So those are the two important things. And any insurance over and above that, hey, wouldn't we all love our kids to have a nice paycheck? So it helps too for the next generation to help them. So again, many different components that insurance play. So yeah, it's good.
Excellent. Did you have any other thoughts or questions that you wanted to bring up?
No, just again, back to what we do. Our company, we really concentrate on the 5 different investment market places that are out there. Insurance is one. We talked a lot about insurance. Mortgages, there's fantastic opportunities in mortgage lending, mortgage investments. Private equity we touched on. Again, that's a lot of real estate focused in private equity. Mutual funds and stocks, that's more the publicly traded market. I'm not a huge fan of that, but there are opportunities in that. So no, that really covers our platform there.
Okay, and if anybody wants to get more information from you or check out your company, where would they go? How would they find you?
Go to my website, www.hogenhout.com. So I'll spell that Hogenhout. We also have a website for our Canadian investment services, so that's just www.canadianinvestmentservices.ca, or they can call me anytime, 416-979-7426.
Okay, well, thank you so much. This has
Awesome.
been a great
Yeah.
interview with you.
Thank you very much.
Yes, thank
Appreciate it.
you.
Thanks a lot.
Thank
Okay.
you. So this is the end of our show for today. Thank you so much. I hope that you got to enjoy a lot of the topics we talked about and definitely look into more and visit Gerry any chance you get. He's a really smart guy. Thank you and take care. That's a wrap.
All right, good job.
Thank you.
It's not both.
Orange
That's
wrap.
okay.
Yeah, I like the 2-hour thing outside of Orangeville. Oh my god.
Did you want to add any more?
How
Or?
did you guys do in there? Everything work? You remember to hit the record button?
Yeah, I mean, I think we touched on
Yeah?
most of it. I mean, there's a lot of stuff I didn't say that I wish I did. But
Like
that's
what?
okay. I
Do you
don't
want
know,
to?
just-
We can add it in.
No, it's just, no, it's okay. I touched on most of the stuff. It's all good.
Okay.
All good.
Okay, you're happy with that?
We'll see. Yeah, that's fine. It's good.
Okay,
It's good.
good job.
Nice.
So we'll see how it turned out. The,
Yeah,
so,
because that one time where I stumbled,
I know I
that
wanted.
was a long answer. Like, I was good. Okay, I'm covering this. I'm covering this. I'm covering this. I'm covering. Then I just 1 hour outside of one choice.